There is a belief so deeply embedded in modern society that most people never think to question it. It's taught in economics classes, repeated by journalists, accepted by investors, and spoken by policymakers with quiet confidence. The belief is simple. Central banks are independent, above politics, immune to elections, guided only by data, models, and long-term responsibility. We're told this independence is the thin wall separating stability from chaos, that without it, politicians would print money endlessly to buy votes, destroy their currencies, and leave economic ruin behind. The central bank, we're assured, is the adult in the room, the one institution willing to say no. It's a comforting story. It explains why inflation is tolerated, why recessions are called necessary, why painful interest rate hikes are described as responsible rather than cruel. And more importantly, it explains why the system deserves trust. Foreign governments hold trillions of dollars in debt because they believe the currency is protected by an institution that cannot be bullied. Investors accept low returns because they trust the rules won't suddenly change. Ordinary people accept economic pain because they're told it's neutral, unavoidable, and fair. But there's a problem. That story only works if independence is real. And when you stop listening to what central bankers say and start watching what they do, a different picture appears. A picture where independence exists on paper, but not in practice. Where policy is constrained not by law, but by math. And where the true priority has quietly shifted from protecting the currency to protecting the system itself. That realization changes everything. To understand why the idea of independence is breaking down, we have to go back, not to conspiracy, but to history. For much of the 20th century, no one even pretended central banks were independent. During World War II, governments around the world faced a simple reality. Total war was expensive, and raising interest rates would make it unaffordable. So central banks did exactly what they were told to do. They printed money and bought government debt, keeping borrowing costs low. There was no debate about inflation targeting, no concern for long-term price stability. The mission was clear: finance the state. This wasn't hidden, it wasn't controversial, it was accepted as necessary. The idea of independence only gained importance after the war when inflation surged and the political cost of money printing became unbearable. A formal separation was established. Central banks were given authority over interest rates, while governments were expected to fund themselves through markets. For decades, the arrangement seemed to work. There were moments that reinforced the myth, times when central bankers raised rates aggressively, caused recessions, and absorbed public anger, all in the name of protecting the currency. Those moments became legend. They were taught as proof that independence wasn't theoretical, it was real. Painful, yes, but necessary. But there is a detail that rarely gets emphasized. Independence only worked because governments could afford it. When debt levels were low, interest rate hikes were survivable, painful but manageable. The state could absorb higher borrowing costs without threatening its own existence. That condition no longer exists. Modern governments carry debt loads so large that the rules have quietly changed. Every percentage point increase in interest rates now adds hundreds of billions in annual costs. At a certain point, fighting inflation becomes indistinguishable from bankrupting the state. And when those two outcomes collide, the decision is no longer neutral. This is where the myth begins to break. A central bank does not need a phone call from a politician to understand this constraint. It doesn't need threats or pressure. The limitation is already embedded in the system. Raise rates too far, and the government's interest bill explodes. Explode that bill, and bond markets destabilize. Destabilize bonds, and banks fail. Banks fail, and the entire financial system fractures. This isn't ideology, it's arithmetic. Once a central bank understands that it cannot raise rates beyond a certain point without triggering systemic collapse,
its mandate quietly changes. Price stability becomes conditional, inflation becomes negotiable, and preserving government solvency becomes the unspoken priority. No announcement is required. No law needs to change. The shift happens automatically. Economists have a name for this condition: fiscal dominance. It describes a system where monetary policy no longer leads the economy, it follows government finances, where inflation is tolerated not because it's misunderstood, but because eliminating it would destroy the state. Once fiscal dominance takes hold, independence becomes symbolic. This is why modern central banking sounds different than it did in the past. Listen carefully to the language. Inflation is no longer something to be crushed, it's something to be managed, guided down, allowed to normalize over time. Every policy decision is described as data-dependent. Every pause is framed as caution. Every pivot is explained as responsibility. This isn't deception for deception's sake, it's damage control, because admitting the true constraint would destabilize the system overnight. If markets believed policy was permanently subordinated to government debt, confidence would evaporate, bonds would reprice, currencies would weaken, capital would move. So the narrative must be maintained. The illusion of independence now does more work than policy itself. The moment this reality became impossible to ignore came during crisis. In 2020, governments around the world shut down their economies and promised to replace lost income with stimulus. Trillions of dollars appeared almost instantly. Officially, the money came from debt issuance. In practice, it came from central banks. Bonds were created and absorbed at unprecedented speed. Market discipline vanished. Constraints disappeared. What once required years of political negotiation happened in weeks. It was efficient. It was necessary, many would argue. But it revealed something crucial. When survival is at stake, independence is optional. And once that line is crossed, it never fully returns to where it was. The coordination didn't end when the crisis passed. It became normalized, refined, hidden behind technical language and emergency facilities that quietly turned extraordinary actions into routine operations. To the public, policy looked restrictive. To markets, it felt supportive. This wasn't contradiction, it was adaptation. The system learned how to appear disciplined while remaining flexible enough to survive its own debt.
This is the foundation of the modern financial system. The central bank is no longer free to choose between inflation and stability. It has already chosen stability. Inflation is simply the cost of that choice. And this is where the story truly begins, because once independence disappears quietly, politics doesn't need to invade loudly. It seeps in, through incentives, through media pressure, through election cycles, through market reactions amplified in real time. No threats required. Everyone understands the stakes. And once you see this structure clearly, the question is no longer whether central banks are independent. The real question becomes independent from what and for whom. Once independence becomes constrained by debt, politics doesn't need to storm the gates. It simply waits. Central bankers are not machines. They operate inside institutions built by politicians. Their authority is granted, not inherent. Their terms are limited. Their reputations matter. Their reappointments are discretionary. And most importantly, they live inside the incentive system as everyone else in power. When economic pain collides with election cycles, pressure doesn't need to be explicit. Everyone understands the stakes. A recession at the wrong moment doesn't just hurt voters, it ends careers. History has already shown us what happens when political incentives meet monetary power. There was a time when pressure on central banks wasn't subtle at all, when leaders openly demanded easier money to win elections, when independence existed on paper
but not in practice. The short-term results were spectacular. Growth surged, markets soared, employment boomed. And then the bill arrived. Inflation didn't just rise, it lingered. Savings were destroyed, wages fell behind prices. Entire decades were defined by instability created by political manipulation of money. That episode was supposed to be a lesson. Independence was meant to prevent its repetition. But the modern version doesn't require shouting matches or recorded threats. It operates through incentives rather than commands, through media narratives, through market reactions amplified instantly, through the knowledge that tightening policy at the wrong moment can turn you into the villain of the election cycle. So decisions get delayed, language softens, risks are reframed, and eventually the institution internalizes its new role, not as an enforcer of discipline, but as a manager of outcomes. This is where something subtle but dangerous happens. The central bank stops protecting the currency from politics and starts protecting politics from the consequences of debt. Once that shift occurs, the priorities flip. Financial markets become the transmission mechanism of stability. Asset prices stop being a reflection of the economy and start being treated as the economy itself. And when markets fall far enough, intervention arrives. Rates are cut. Liquidity is injected. Confidence is restored. This belief becomes so consistent that it stops feeling like a theory and starts functioning like a rule. If asset prices rise, gains are private. If they fall too far, losses are softened. This asymmetry quietly reshapes behavior.
Risk stops meaning the same thing it used to. Leverage increases. Time horizons shorten. Complexity grows. Strategies form around one assumption: policy will respond. Not because productivity collapsed, not because innovation failed, but because confidence itself is now a policy objective. This is not accidental, it is structural. In a system where markets are wired directly into public confidence, protecting them becomes politically necessary. Falling asset prices don't just hurt investors, they hit pensions, employment, consumer sentiment, headlines. A market crash is no longer just an economic event, it's a political one. So policy adapts again. The language of independence remains, but behavior changes. Tightening becomes performative, easing becomes technical. Liquidity moves quietly through back channels while public messaging emphasizes restraint. This is not incompetence, it is constraint. The system is trying to do the impossible: suppress inflation without triggering a debt crisis, slow markets without breaking confidence, project authority without fully exercising it. Every move becomes a compromise, and compromises compound. One of the clearest signs of this regime is how quickly interventions are justified as temporary. Emergency tools become permanent features. Balance sheets expand, contract slightly, then expand again to new highs. Each cycle leaves more money in the system than before. Each crisis resets the baseline upward. Over time, what was once extraordinary becomes expected. What was once inflationary becomes neutral. What was once reckless becomes standard, and all of it is framed as necessary. This is where inequality stops being accidental. Those closest to assets benefit from protection. Those dependent on wages absorb inflation. Those with access to credit gain flexibility. Those who rely on savings lose purchasing power. The central bank didn't design this outcome intentionally, but it perpetuates it. By prioritizing financial stability over price stability, it locks in a hierarchy. By cushioning markets, it amplifies wealth effects. By avoiding short-term pain, it ensures long-term erosion. And once this structure is in place, reversing it becomes politically toxic.
Imagine allowing losses to fully clear, markets falling 40%, asset prices resetting, inflation crushed decisively, and unemployment spiking as a result. That world might be healthier in the long run, but no modern political system can tolerate it, so the compromise continues. This is the midpoint of the story, the realization that independence didn't fail because of corruption or conspiracy, but because it became incompatible with the scale of debt and the structure of modern economies. The central bank is trapped. If it tightens aggressively, it risks sovereign stress, market collapse, and political backlash. If it eases, it entrenches inflation and inequality. There is no clean exit. So it chooses survival, and survival means preserving the system as it exists, not correcting its flaws. This is why the narrative matters so much. The myth of independence must be maintained, because acknowledging constraint would destroy confidence. If markets believed policy was permanently subordinated to debt, everything would reprice instantly. Interest rates would rise on their own. Currencies would weaken, capital would flee. Belief is now the final line of defense, which brings us to the most important transition of all.
Because once markets and governments become fused, the consequences stop being purely economic. They become geopolitical and eventually personal. When belief begins to weaken, it doesn't collapse all at once. It thins. At first, the cracks appear far from home. Foreign buyers slow their purchases. Long-term commitments quietly shorten. Confidence doesn't disappear. It becomes conditional. For decades, the global financial system rested on a simple assumption. The currency at the center would always protect its value, even when doing so was painful. That promise mattered more than yield. It's why governments, institutions, and central banks around the world were willing to hold enormous amounts of debt that paid very little. Trust was the return. But trust depends on behavior, not declarations, and over time, the behavior changed. When inflation surged and wasn't crushed decisively, it sent a signal. When deficits became permanent, it sent another. When emergency measures stopped being temporary, the signal grew louder. The message wasn't that the system was collapsing, it was that priorities had shifted. Foreign holders didn't need speeches to explain this. They watched actions, balance sheets expanding, debt issuance accelerating, political constraints shaping financial outcomes. So they adjusted. Some diversified. Some reduced exposure. Some stopped recycling surpluses back into government debt. Quiet moves, rational moves. In a system this large, even small changes matter. Because the market for government debt only works when demand keeps pace with supply, and supply has become relentless. Trillions issued year after year, not to build future growth, but to roll old obligations forward. When demand weakens, something has to absorb the excess. In theory, higher yields should do the job. Prices fall, interest rates rise, buyers return. But the constraint still exists. Higher yields mean higher interest costs, and beyond a certain point, those costs threaten the solvency of the state itself. This is where the system enters its final transformation. When markets won't absorb the debt at acceptable rates, the central bank steps in, not as a temporary backstop, but as a structural buyer, not to stimulate growth, but to prevent failure. This is yield control in everything but name. Sometimes it arrives openly, sometimes quietly, sometimes through emergency lending facilities, sometimes through accounting rules that turn losses into temporary mismatches. The mechanics vary. The outcome does not. The central bank becomes the buyer of last resort for government debt. Independence doesn't end with a declaration. It ends with necessity. This path is not theoretical. Other countries have walked it.
They kept rates low, they printed aggressively, their currencies weakened, living standards adjusted downward. None of them described it as surrender, they described it as stability. And once that door opens, it never fully closes, because reversing course would trigger the very crisis the intervention was meant to prevent. This is the trap. At this stage, inflation is no longer an enemy to defeat. It becomes a tool to manage, a way to reduce real debt burdens quietly, a tax that doesn't require a vote. Savers pay it. Wage earners feel it.
Asset holders are partially insulated. Politically, it is far easier than austerity. But something else changes here. When money creation becomes a survival tool, it stops being neutral. Access becomes power. Liquidity becomes leverage. Systems once designed as infrastructure become instruments of control. The world notices. Countries that once trusted the system begin looking for alternatives, not because they expect perfection elsewhere, but because dependence now carries risk. So hedges appear. Trade is settled outside the dominant currency. Reserves diversify. Physical assets are accumulated. The goal isn't rebellion, it's insurance. This shift doesn't happen overnight. It unfolds slowly, then persistently. And once it begins, it reinforces itself. Less demand for debt requires more intervention. More intervention weakens credibility. Weaker credibility accelerates hedging. A feedback loop forms. And all of this happens while the public narrative insists nothing fundamental has changed. Inflation is cooling. Markets are resilient. Growth is stronger than expected. These statements aren't always false, they're incomplete, because the system is being stabilized, not healed, supported, not corrected, kept functional, not reformed. That distinction matters. When stability is maintained at the cost of integrity, decay becomes gradual instead of sudden, and gradual decay is harder to resist because it doesn't trigger panic, it triggers adaptation. People adjust their behavior, they save less, they take on more risk. They borrow not because they want to, but because holding cash feels like losing. Behavior changes not because people become reckless, but because the rules punish caution. This is how inflation reshapes incentives. But inflation has limits. Push it too far and trust breaks. Long-term planning collapses. Social tension rises. At that point, authorities face a choice: restore discipline through pain, or preserve control through restriction. History is clear about which option is usually chosen. When monetary credibility erodes far enough, governments don't suddenly rediscover restraint. They look for ways to contain behavior, to close exits, to keep capital from leaving the system they depend on. This is how financial repression turns overt. It doesn't begin with seizures. It begins with rules, reporting requirements, restrictions framed as safeguards, controls justified as temporary emergency measures. Then come incentives, punishments, permissions, and eventually prohibitions. There is precedent for this, not as speculation, but as documented reality. When currencies fail and debt overwhelms states, competition is restricted. Alternatives are discouraged. Real assets become sensitive, not because they're illegal, but because they represent escape. When the system can no longer afford choice, choice becomes the threat. This is why the myth of independence matters, not because it changes tomorrow's interest rate decision, not because it predicts a single dramatic event, but because it shapes expectations about the future. If the central bank were truly independent, painful corrections would still be possible. Debt could be confronted. Inflation could be crushed decisively. Trust could be rebuilt through discipline. But an institution constrained by debt cannot act freely. It must prioritize continuity over correction. And continuity at this stage requires managing people's options, not just prices. That's the part rarely discussed. Because once monetary policy becomes a tool of survival rather than stability, It stops being neutral. It becomes political in the deepest sense. It decides who bears the cost and who is protected. When systems reach this stage, the burden always moves downward, from institutions to individuals, from policy to daily life, from abstraction to consequence. Up until now, most of the cost has been hidden, spread thinly across time and population, explained away with averages and reassurances. Inflation described as temporary, debt framed as manageable, stability celebrated as success. But stability maintained through constant intervention is not strength, it is postponement. And postponement has a cost. At first, that cost shows up quietly. Purchasing power slips, savings feel less effective, long-term planning becomes harder to justify. People don't panic, they adapt. They save less because saving no longer feels rewarded. They take on more risk because caution falls behind. They accept leverage not because they want to, but because standing still feels like moving backward. This is not moral failure, it is rational behavior inside a distorted system. When money no longer functions as a reliable measuring stick, behavior changes around it. Time horizons shorten. Asset ownership replaces productivity as protection. Financial decisions become defensive rather than aspirational. This is how monetary systems reshape society without ever announcing it. And this process is not new. History shows the same pattern repeating across eras and countries. Not because people are corrupt, but because incentives are powerful. When states accumulate obligations they cannot realistically repay, they rarely choose default or austerity first. They choose erosion, inflation, negative real rates, quiet transfers from savers to borrowers. These tools feel gentler compared to collapse. They don't require votes. They don't provoke immediate revolt. Most people experience them as inconvenience rather than catastrophe, until they don't. When erosion reaches its limits, policy escalates. Controls appear, not as punishment, but as protection. Reporting requirements justified as transparency. Restrictions framed as stability measures. Incentives offered to guide behavior in responsible directions. Choice narrows gradually.
Not because freedom is declared dangerous, but because exits become inconvenient. This is how financial repression becomes normalized, not through force at first, but through conditioning. People are told it's temporary. They're told it's necessary. They're told it's for their own good. And often they believe it, because the alternative feels worse. But repression is never about cruelty. It's about control when flexibility is gone, when debt cannot be allowed to fail, when systems must be preserved even as they strain. At that point, money stops being neutral infrastructure. It becomes governance. This is why understanding the myth of independence matters, not because it changes tomorrow's policy meeting, not because it predicts a single dramatic event, but because it clarifies direction. An institution constrained by debt cannot behave like one guided solely by principle. It must choose continuity over correction. It must prioritize stability over discipline. It must manage outcomes rather than enforce rules. And when that happens, the system no longer distributes costs evenly. Those closest to assets are insulated. Those dependent on wages feel pressure. Those holding cash absorb erosion. Those with access to credit gain flexibility. None of this requires intent. It emerges automatically, which leaves individuals in an uncomfortable position. You cannot vote on balance sheets. You cannot opt out of inflation. You cannot demand independence back into existence. You participate whether you consent or not. But you can understand the environment you're in. You can recognize that when money is managed rather than measured, holding only claims on the system increases dependence on its survival strategy, that long-term fixed obligations behave differently when currencies weaken, that optionality becomes more valuable as certainty declines. This is not a call to panic. It is a call to awareness. Empires rarely collapse overnight. They decay through adaptation, through myths that persist long after conditions change, through temporary solutions that quietly become permanent. The myth of the independent central bank belongs to a different era, a lower debt era, a simpler era, an era where discipline was still affordable. That era is gone. What replaces it is not chaos, it is management. Managed inflation, managed stability, managed expectations, a system that works until it doesn't. And when belief finally breaks, it never breaks evenly. Some adjust early, some adjust late, some trust the story until the end. The danger is not that this process accelerates tomorrow. The danger is that it continues just slowly enough for most people to adapt, while the foundation weakens year by year. Because by the time the curtain is pulled back completely, the choices are no longer theoretical. They're already made. The independent central bank was the noble fiction of the 20th century, a useful illusion that allowed politics and money to coexist without openly colliding. Today, that collision is no longer avoidable. It's simply managed. And once you understand that, you stop asking whether the system will protect you. You start asking how much of your life depends on it. That question, not inflation, not rates, not markets, is the real awakening.